Hey, this is Mark from Caliber Home Loans. Today I want to talk to you about the housing market and what's going on in reality. Uh, Buyers are having to go in over list and they're having to put in appraisal waivers, which means that if the value comes in less than the purchase price, they're still willing to continue with the purchase up to certain limits. So I want to talk to you about that today and show you an example and show you how there are some options around having to bring in just a lot more money to closing. So here I'm showing what we call a total cost analysis. It's a program that I use is through Mortgage Coach. So I'm just going to highlight what the market is seeing right now. So this first column, it's the appraisal equals the purchase price. So we're assuming a purchase price of $400,000, 20% down, loan amount's $320. So we're not using closing costs, prepaids, or escrows. So your downstroke is $80,000. Down payment's gonna be $80,000. So that's all well and good, but in this market, what's happening is that a lot of times the appraisals are coming in lower than the contract price. So we're assuming here that the appraisal comes in $40,000 low. So the appraised value actually comes in at $360. So at 20% down, your mortgage amount is going to change from $320 to $288. The reason for that is because the mortgage amount is based on the lower or the lesser of the appraised value or the purchase price. So at 20% down or 80% of the value, the mortgage amount is going to drop. And then you have to make up the difference. So you have to add $40,000 to your cash to close to make up the appraisal gap, what we call the appraisal gap between the appraised value and the actual purchase price. So in this case, you've gone from $80,000 to $112,000 for your down payment. So in column 3, what we're doing is we're leaving the mortgage amount the same as original. So you're back to $320. You've still got that $40,000 shortfall in the appraised value. But instead of lowering the mortgage amount, we are going to just add a little bit of mortgage insurance. And I know a lot of people don't want to pay mortgage insurance, and I get that, but it's going to save you a bundle of money because now you're back down to your $80,000 of cash to close. And it only raises your payment about $75 based on our assumptions for this loan. So that's not a bad deal. The other option is to use what we call a single premium mortgage insurance. And so you just pay a one-time fee. And in this case, I was able to just roll it into the loan. So it actually raises your payment all of $16 from the original transaction. And you're at $80,000 for closing. So these are options that we're showing our clients. There are other options. There are strategies to use a VA loan, even if you're putting 20% down. There's actually a strategy to use a MSHDA, the new MSHDA MI 10K program. We'll cover those in a separate video. So everybody's situation is a little bit different. So I can build these templates out for your specific situation, whether you're putting 20% down or you're starting out with less than 20% down. Sometimes there's still maneuvering room to manipulate the mortgage and using mortgage insurance, whether it's a monthly amount or a single premium, to keep your cash to close at the same as it was as the original purchase price. So give me a shout, 248-705-8431. I'd love to help you out. Thanks a lot and have a great day.